surge today. Both the benchmark indices surge over 1%, the Nifty and the Sensex. The Sensex spike over 1,000 points and reclaiming that 80,000 level. So the benchmark indices and the stock markets, of course, reflecting this massive rally. While, of course, we have seen gold prices ease marginally in trade today. So what really is causing this rally in stock markets and this easing of gold rates? Well, to decode this, I'm joined by Chokkalingam. He is the founder of Economics Research, also a senior market expert. Thank you for your time. I'd like to begin by asking you, for all those wondering, okay, what is causing this rally in stock markets and what is causing this easing of gold prices? What are the factors at play, you'd say?
Yeah. So first on the market, it's a very pleasant rally. Not expected because of a lot of fear on the border. Uh, the first fact is that so far no development on the border itself is a good news so far. And secondly, the most important is some development on the global front on trade war, tariff war. Now, what has happened? U.S. The fag end of last week mentioned that it is in talk with 18 nations on the trade agreements, and interestingly, China exempted some of U.S. products from 125% import duty. So that also added to some confidence in the market that the aggressive tariff war between China and America, and also between US and the rest of the world, may not be too aggressive. So this confidence is slowly gaining. And third, on the domestic front, the US Trade Secretary had mentioned at the fag end of last week that India is the first country to complete the bilateral trade agreement talk with the US. So that also gives some hope that India may not be part of aggressive duty hike by US on goods exported from here. So these are the three reasons which helped our market to recover quite significantly today, in my view. As
Right.
far as
And gold rates easing, what would you say about that? Why are gold rates easing for all those wondering?
Yeah. So one has to understand that gold is only an investment speculative commodity. It doesn't have much industrial use. So therefore, the traditional economic parameters related to supply demand equilibrium are not applicable to gold, which means that yes, it will be volatile. There are times when the gold was stagnating even for 10 year in dollar term. So having said that, yes, gold has given a phenomenal return. That itself is a risk factor because very difficult for us to expect the gold to continue to maintain that kind of momentum. And secondly, the most important fundamental reason is that because of the tariff war, last week the global agencies, global institutions like World Bank, IMF, they have revised down the GDP growth rate for both US and Chinese economy. So definitely, slowing down global growth is negative for precious metals like gold and even silver, because if there are strong deflationary condition or growth slowdown, that is supposed to bring down the demand for gold as well. So these are the two reasons in my view, and as I mentioned earlier also, I don't think gold can rally in a big way in the short term from here. It has already done that journey a lot. So at best, it may give anywhere 3-4%, but in the worst case scenario, it can fall even 5 to 10% from here. So one should be cautious in going very aggressive in buying gold at current juncture.
Right. For those saying, okay, then please tell us your outlook for the stock markets and for gold prices in the near term. Of course, geopolitical concerns remain. But if in the near term you had to predict something for both commodities as well as equities, what would you say?
Yeah. So commodities, including precious metals, are likely to be weak till there is a clarity on the trade war. Because, as I mentioned just now, that the trade war is supposed to bring down the global growth, including the two largest economies on the earth, namely US and China, Chinese economies. So that too is negative for metals, including gold and silver. So I don't see more than 3 to 5% upside for gold, particularly in the next 3 to 6 months. Now, as far as the Indian market is concerned, I have been consistently maintaining that India is far better off than the the US economy and the Chinese economy. US economy is at the receiving end in terms of imposing very aggressive duty on import of almost all major goods into the country and almost among all the major exporting countries. So US economy will bear the maximum pain in terms of very high inflation, slowing down consumer demand, and therefore growth slowdown. Similarly, China is economy which is worst affected by the trade war because maximum duty hike is on the Chinese product, and China also depends to the extent of 20% of the goods exported as percentage of GDP. So Chinese economy also will have a lot of pain. So therefore, India is far superiorly positioned. Our goods export is only 10% of the GDP, and it's a service-driven economy. And manufacturing sector accounts only for some 16% of the total GDP. So we are better off after the revision of downward revision of the GDP growth by World Bank and IMF. Still, India's GDP growth is expected to be about 6%. That is going to be the fastest growth among major economies. So, therefore, in the short to medium term itself, I am extremely bullish unless, unfortunately, something happens on the border. Our Indian market should give 10 to 12% return in 2025 itself, and the banking sector, among all the sector, will lead this rally in the current calendar year.
Right. And for those investors, of course, looking at sectors to look at in the near term or looking at how to really approach the equity market as well as the commodity market with gold prices easing, what would you say?
Uh, I would say that maintain minimum 30-40% of your wealth in the fixed income securities. The remaining, you can continue to hold on 5 to 10% of your overall assets maximum in gold form, but I would not suggest now, even if it is less than 5-10% of your wealth, should not aggressively rush to accumulate gold. What you are holding, you can hold on, and focus on the balance of wealth on the equity. Again, conservative investors can put 50% in the large cap stocks. The balance 50% can be put in small and mid cap because you have a 4,000 companies in the small and mid cap space where you can find a lot of growth opportunities, deep value opportunities. However, in the Nifty and Sensex, among nine major sectors, a majority of the sectors are still having that single digit growth syndrome. That is, volume growth is likely to be in single digit. So, only the bank is supposed to grow in a strong double digit. It's a credit. But otherwise, whether you take a cement or FMCG or IT services, all of these sectors are having a single digit growth syndrome. So, therefore, I would not suggest to putting more than 50% of the equity asset allocation into large caps. One should invest 50% small and mid cap, but without losing the quality of the management, balance sheet, and valuation comfort.
Right. Thank you so much for sharing your thoughts and, of course, for helping our viewers understand this. We will continue to track equities as well as commodities going forward. Thank you for your time.